Federal Reserve Chair Jerome Powell issued a stark warning today, cautioning that President Trump's new tariffs pose a significant threat to the U.S. economy. Powell's remarks, delivered during a press conference following the Federal Reserve's latest policy meeting, sent shockwaves through financial markets already on edge due to escalating trade tensions. Powell stressed that the tariffs, far from achieving their intended goal of protecting American jobs, could stifle economic growth and lead to higher prices for consumers. The tariffs, which target a wide range of Chinese imports, including electronics, machinery, and consumer goods, are the latest in a series of protectionist measures imposed by the Trump administration. He pointed out that tariffs are essentially taxes on imported goods, which are ultimately passed on to consumers in the form of higher prices. This, he warned, could lead to a decline in consumer spending, which is a major driver of economic growth. Moreover, Powell noted that the tariffs have created uncertainty for businesses, making them less likely to invest and hire. This uncertainty, he said, is already having a chilling effect on the economy, as evidenced by recent data showing a slowdown in business investment and job growth. The tariffs imposed by the Trump administration are unprecedented in their scope and scale. The administration has slapped tariffs on hundreds of billions of dollars worth of goods imported from China, covering a wide range of products from steel and aluminum to electronics and consumer goods. The tariffs, which range from 10% to 25%, have significantly increased the cost of imported goods for American businesses and consumers. The administration argues that the tariffs are necessary to protect American jobs and industries from unfair competition from China. They accuse China of engaging in a range of unfair trade practices, including intellectual property theft, forced technology transfer, and currency manipulation. However, economists and business leaders have criticized the tariffs, arguing that they are counterproductive and will ultimately harm the U.S. economy. They point out that the tariffs are essentially a tax on American consumers and businesses, who will end up paying higher prices for imported goods. Furthermore, critics argue that the tariffs are likely to provoke retaliation from China, which has already imposed retaliatory tariffs on billions of dollars worth of American goods. This tit-for-tat escalation of tariffs, they warn, could lead to a full-blown trade war, which would be devastating for both the U.S. and global economies. Financial markets reacted swiftly and negatively to Powell's warning, with stock prices plunging and bond yields spiking. The Dow Jones Industrial Average tumbled by over 500 points, or nearly 2%, following Powell's remarks, wiping out all of its gains for the year. The S&P 500, a broader measure of the stock market, also fell sharply, dropping by over 1.5%. Investors, already jittery about the prospect of a trade war between the United States and China, interpreted Powell's warning as a sign that the Federal Reserve is becoming increasingly concerned about the potential economic fallout from the trade dispute. The Federal Reserve, tasked with maintaining price stability and promoting full employment, has been gradually raising interest rates in recent years as the U.S. economy has strengthened. However, the Federal Reserve also has a mandate to keep inflation in check, and rising prices caused by tariffs could force the central bank to continue raising interest rates even if economic growth begins to falter. Investors, uncertain about the future direction of the economy and the Federal Reserve's response, have become increasingly risk-averse, leading to the sharp sell-off in the stock market. Section 4. Inflationary pressures. One of the most significant risks posed by President Trump's tariffs is the potential for increased inflation. Tariffs, essentially taxes on imported goods, raise the cost of those goods for businesses and consumers alike. These higher costs ripple throughout the economy, leading to price hikes on a wide range of products and services. The Federal Reserve, tasked with maintaining price stability, closely monitors inflation and adjusts interest rates to keep it in check. The central bank aims for an inflation rate of around 2%, which it considers to be healthy for a growing economy. However, the tariffs imposed by the Trump administration threaten to push inflation above this target, potentially forcing the Federal Reserve to raise interest rates more aggressively than it would like. Consumers are already feeling the pinch of higher prices, as the cost of imported goods, from washing machines and refrigerators to clothing and electronics, has risen steadily since the tariffs were imposed. Section 5. Trade war escalation. President Trump's tariffs have not gone unanswered. China, the target of most of the tariffs, has retaliated with its own tariffs on billions of dollars worth of American goods, including soybeans, pork, and automobiles. This tit-for-tat escalation of tariffs has raised fears of a full-blown trade war, which could have devastating consequences for both the United States and global economies. The trade war has already disrupted global supply chains, increased costs for businesses, and created uncertainty in the global marketplace. Businesses are hesitant to make long-term investment decisions, fearing that the rules of the game could change overnight. The International Monetary Fund, or IMF, has warned that the trade war is a serious threat to the global economy, and has urged the United States and China to resolve their differences through negotiation rather than escalation. The trade war has also strained relations between the United States and its allies, many of whom have been caught in the crossfire. Section 6. The Fed's Balancing Act. The Federal Reserve faces a delicate balancing act as it navigates the uncertain economic waters churned up by President Trump's trade policies. On the one hand, the central bank is tasked with maintaining price stability, which means keeping inflation in check. On the other hand, the Federal Reserve also has a mandate to promote full employment, which means supporting economic growth. The tariffs imposed by the Trump administration have made this balancing act even more difficult. As discussed earlier, tariffs can lead to higher inflation, as businesses pass on the increased cost of imported goods to consumers. This puts pressure on the Federal Reserve to raise interest rates to keep inflation under control. However, higher interest rates can slow down economic growth by making it more expensive for businesses to borrow money and invest. Section 7. A gamble or a strategy. President Trump's decision to impose tariffs on Chinese goods has been met with a mixture of praise and condemnation. Supporters argue that the tariffs are necessary to protect American jobs and industries from unfair competition from China. They argue that China has been engaging in a range of unfair trade practices for years, including intellectual property theft, forced technology transfer, and currency manipulation. Critics, however, argue that the tariffs are counterproductive and will ultimately harm the United States economy. They point out that the tariffs are essentially a tax on American consumers and businesses, who will end up paying higher prices for imported goods. Furthermore, critics argue that the tariffs are likely to provoke retaliation from China, which has already imposed retaliatory tariffs on billions of dollars worth of American goods. Only time will tell whether President Trump's tariff strategy will achieve its intended goals or backfire spectacularly.